Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. Well, continuing off the webcast that I did with Dr. Ed, we wanted to talk a little bit more about looking at certain aspects of what the Fed is predicting. And next week, we're going to talk about the relationship of GDP and shorter-term rates on a historical basis. This week, we want to look at inflation in here. Because when we think about inflation, the Fed is projecting, similar to their projections back in June, 1.5 to 1.7% on PCE inflation. In fact, what we saw this past week in terms of the new number on PCE coming out is that it's running even below the rate that the Fed is projecting at 1.46% on the most recent number, down from 1.58%. So when we think about that, those low inflation levels, it's another reason to think that there's no pressure for the Fed to push up those short-term rates that everybody's anticipating to happen next year, that there's nothing out there inflation-wise. In fact, showing the world in terms of the world economy slowing down. Take a look at this in terms of Bloomberg Commodity Index, which is a basket of different commodities that when we look at that, look at the trending in this over this period of time since the Great Recession, is that we're now down to 5-year lows in terms of collection of commodities. Now one could sit there and say, well, wheat has a banner harvest, oil prices down, yet all of these things are indicating globally that there's no push on the economies and bringing about lower levels of inflation, once again suggesting that these low interest rates will remain low for a considerable period of time. This is Jay Brew, co-chairman of Seafried and Brew. Have a great week.